Okay, let's unpack this. You know that feeling. Like when you hear about someone who's really built wealth and you wonder, how did they do that? Or maybe you've heard family stories about a missed opportunity. If only grandma hadn't sold that piece of land. It can feel like becoming truly wealthy is this big secret, right?
Yeah, totally. Like it happens through luck or maybe, I don't know, shady connections.
Exactly. That sense of mystery around building wealth the right way, it feels pretty common.
It absolutely does. That question of how significant wealth is accumulated, where it actually comes from. Yeah, it often feels shrouded in mystery for many people.
There's this tendency maybe to assume it must involve some kind of exclusive network or an unclear, perhaps a dubious path.
Or just something completely out of reach.
Right. It feels overly complicated. But you've brought us some fascinating sources that really sort of cut through that.
Yeah, dig right to.
They suggest there are practical, tested approaches to building wealth, and, they're not about finding some magic get-rich-quick button.
No, and that's the crucial distinction the sources make. They focus on sustainable, proven methods, not the kind of schemes that promise wealth overnight, but, often carry immense risk or just plain don't work.
Okay. So our mission for this deep dive, then, is to explore two very different paths laid out in this material.
Right.
First, we'll look at what the sources describe as maybe the simpler path, building wealth through consistent long-term investing habits.
The slow burn, kind of.
Yeah, exactly. And then we're going to dive into the far more complex world of active trading.
Definitely more complex.
We'll pull out the core ideas and, importantly, really shine a light on the unique challenges of each, all straight from the material you shared.
Sounds good. Let's get into it.
All right, let's start with that first path, building wealth through consistent investing. The sources immediately challenge that popular fantasy, of getting rich fast, don't they?
Oh, yeah. They are very clear on this. There's basically no healthy, low-risk way to become truly wealthy overnight. It just doesn't happen like that. The sources point out that successful people typically achieve significant success or build a valuable business first. That's what generates the capital. Then they figure out how to invest that capital intelligently to grow their wealth further.
So it's often the success that provides the fuel for wealth building through investing, rather than the investing being the source of the initial success. That kind of flips the script on a common assumption.
It really does. And for most people, the fundamental strategy presented is surprisingly accessible. It's about establishing a regular habit.
Okay.
A habit of investing small amounts consistently over a long period, think 10, maybe 15 years.
And this doesn't mean you have to, make some drastic life change, quit your job, move across the country, anything like that.
Not at all, and this is a key point the sources really emphasize. This approach is about integrating a small, consistent behavior into your existing life.
Right.
It's not about drastic upheaval or anything.
That makes it feel much more achievable. And you don't need to start with a giant sum of money either.
Absolutely not. The sources suggest beginning with very small amounts weekly, like even just $5 or $10.
Wow, okay.
And you can start with accessible assets. Physical gold is always an option, they mention. Digital gold, like Bitcoin, is also brought up as becoming easier to access. The material notes that while, online platforms for buying tiny bits might have regulatory uncertainties now, future developments could make them much safer and simpler down the line.
Okay, so start small, build the habit with something relatively straightforward like gold or Bitcoin. What's the next step as you get going?
Well, the sources explain that as this habit solidifies, and you naturally become more curious and learn about markets, which just kind of happens organically once you start.
Right, you get drawn in.
Exactly. You can gradually expand your portfolio. You might start looking into stock markets, maybe identifying large influential companies with good long-term potential.
Like, hypothetically, if companies similar to Digicala or Snap in their specific markets were publicly traded, those kind of big players?
Precisely. Those are used as hypothetical examples in a specific context, large, seemingly robust digital companies. But the critical part is doing your own research based on what's available where you are.
Sure, yeah.
You might add other assets too, like silver perhaps. The core idea is that the habit of investing itself is the engine. That's what drives your learning and your exploration of other options.
It sounds like the habit is the strategy, almost more than what you invest in initially.
That's a really great way to put it, yeah. And this habit has a powerful built-in benefit. It acts as a barrier against impulsive spending.
How does that work? How does investing stop you from spending?
Well, think about it. Money you've invested is less immediately accessible than cash in your pocket or even in a checking account.
Right, yeah. Takes effort to get it out.
Exactly. So if a small problem pops up or you get tempted by, I don't know, a last-minute vacation offer, you're less likely to tap into those investments, especially if they happen to be temporarily down in value. Selling then feels like you're locking in a loss.
The psychological pain.
Yes. It creates this psychological resistance compared to just, swiping a card with readily available cash.
So the act of investing literally puts a speed bump between you and your money, forcing you to think twice about spending it impulsively. That's actually quite clever.
It really is. It kind of leverages human psychology in your favor to build resistance to unplanned spending. And the sources suggest that after a significant period of consistency, say maybe 3 or 4 years, you can consider taking out a portion of the profit.
Okay, just the profit.
Strictly the profit, not the original capital. Take it out as a reward.
A reward for sticking to the plan, like positive reinforcement.
Exactly. Maybe take half the profit for something enjoyable, a nice trip, a significant purchase you've wanted, and then reinvest the rest. This reinforces the positive behavior, lets you enjoy the benefits of your discipline, and importantly, keeps the momentum going for the next few years.
So, okay, let's connect this back. Why does this particular path matter to you, the listener? I guess the sources present this not as some distant dream, but as a tangible, manageable way to start building wealth long term.
Exactly. It's about focusing on building a sustainable habit, something that can compound over years, maybe even create a legacy. People learn by watching consistent behavior.
It's the quiet power of small, consistent actions just adding up over time.
That's it.
Okay, that paints a really clear picture of one approach.
Right.
Now, let's shift gears pretty dramatically and look at the second path discussed, the path of the trader. This feels like a whole different ballgame.
It is a completely different endeavor, yeah. A trader is someone who's frequently buying and selling financial instruments. Currencies, cryptos, stocks, commodities.
Stuff that moves fast.
Right, aiming to profit from short-term price fluctuations. It requires a level of constant activity and focus that's really distinct from long-term investing.
And the sources make it abundantly clear this is not the simpler path.
Not by any stretch, no. They strongly emphasize that becoming a successful trader is a highly skilled profession. It requires significant time and dedication just to develop proficiency.
How much time are we talking?
Well, they suggest potentially 3 to 5 years if you're learning on your own.
Wow.
Or maybe at least 1.5 years, maybe more. Even with solid guidance or mentorship, it's a craft you have to learn and hone. It's definitely not something you just pick up after watching a few online tutorials.
Okay, here's where it gets really interesting, I thought. The sources describe the unique nature of trading success. They say it's unlike most jobs where your effort, relatively directly correlates to income and you're competing with external factors.
Yeah, this is maybe the most profound insight they offer about trading. Success isn't primarily about conquering the market or outsmarting other traders.
What is it then?
It's fundamentally a confrontation with yourself. You are the primary challenge you face as a trader. Unlike, say, a typical salary tied to hours worked or output achieved, trading success is deeply interwoven with your internal state, your emotional reactions.
It's literally you against you. That sounds exhausting.
It absolutely can be. And the sources break down trading success into 3 key pillars. And interestingly, market analysis is only a small part of it.
Okay, what are the pillars? Let's hear them.
Right. So analysis, which is about predicting market movement, they say contributes less than 30% to success.
Less than 30, okay.
And there's management. This covers capital management, risk management, like setting stop losses, profit management, that's around 30 to 40%.
Still not the biggest piece?
No, because the largest factor, contributing something like 50 to 70%, is psychology or sentiment, your ability to control your emotions.
Whoa. Okay, so your own brain is more than half the battle. That's kind of terrifying, actually, but it makes perfect sense if the struggle is internal, like you said.
It's the absolute final boss, as the sources vividly describe it. The biggest hurdle for any trader is managing their own emotions. Fear, greed, anxiety, excitement.
All the fun stuff.
All of it. These feelings are constantly triggered by every market swing, whether you're winning or losing. Your emotional state can change dramatically within a day, even within an hour.
Yeah.
And that makes consistent, rational decision-making incredibly difficult, especially when you're under pressure.
So when emotions take over, what happens? What kind of reactions do the sources describe? Do people just freeze up?
Sometimes, yeah. They describe typical emotional responses under pressure. There's freeze, just paralysis, the inability to take action even when your plan says you should.
Okay.
There's flight, sort of avoiding responsibility, maybe closing trades too early or just walking away from the screen altogether.
Right.
And then there's fight, which is seeking revenge against the market.
Yeah.
Trading impulsively and irrationally, often right after taking a loss, trying to win it back.
Ooh, that fight reaction sounds like where things could go wrong really, really quickly.
It is extremely dangerous. The sources highlight that the market environment is almost like designed to trigger your emotions and exploit them. Allowing fear or greed or frustration to dictate your decisions leads directly to inconsistent results and often significant capital losses. It's these psychological pitfalls that sink most aspiring traders, not necessarily bad analysis.
Okay, so if your own psychology is the biggest opponent, what tools do the sources suggest for navigating this inner battle?
Right. Well, the most essential tool, according to this material, is the trading plan.
A plan.
And this isn't just some abstract idea. It's presented as a meticulously written set of strict rules and protocols
Yeah.
for every single aspect of your trading activity.
Like your personal rule book for market survival. Got it.
Exactly. Key components include crystal clear rules for when to enter or exit a trade based on your specific strategy, not your gut feeling. It details how much capital you allocate per trade. That's capital management. Strict limits on potential loss per trade risk management, like using stop losses. Absolutely. But also crucial are daily, weekly, and even monthly loss limits. It covers your trading style, the time frames you use, and importantly, includes specific rules for managing your own psychology.
Rules for your psychology? Like what?
Like, if I feel X, I must do Y. Or if I hit my daily loss limit, I stop trading for the day, period. No exceptions.
Why is having this written plan so critical? Why not just keep it in your head?
Because it completely bypasses emotional influence and guesswork, or at least it's designed to. When a trading situation arises, you don't stop and think, how do I feel about this?
You check the book.
You consult your plan. It tells you precisely what action to take, or maybe not to take. This structure optimizes your decisions and enforces unwavering discipline.
Okay.
The sources use an analogy. A professional fisherman doesn't just blindly go to the sea hoping to catch something. Right?
No, they know what they're after.
Exactly. They have a detailed plan, what fish they're targeting, where, when, what gear to use. A trader needs that same level of specific planning for their market, their strategy, and importantly, how they'll manage their own mental state while doing it.
Okay, the plan is foundational. What other practical steps help manage those powerful emotions that can derail the plan?
Well, a very practical approach mentioned is minimizing the financial impact of any single trade, keeping the stakes low, emotionally speaking.
How low?
The sources recommend keeping the risk per trade incredibly low. Maybe a maximum of 1% of your total capital for a swing trade, possibly even as low as 0.5% for a faster style like scalping.
0.5%. That's tiny. Why is keeping the risk percentage so small so important?
Because when the actual dollar amount you stand to win or lose on any single trade is tiny relative to your overall capital, it dramatically reduces the intensity of the emotional trigger.
Ah, less to get worked up about.
Exactly. Losing, say, $10 on a $1,000 account feels very different, much less likely to induce panic than losing $100 on that same account.
Right.
It's similar to a salaried institutional trader. They might be trading millions, but their personal income isn't directly on the line for that specific trade's outcome, so they can remain more objective. Keeping your individual trade risk small helps you maintain that objectivity.
That makes a lot of sense. It's about reducing the potential for emotional shock, keeping things rational.
Precisely. And beyond the plan and the small risk size, physical and mental preparation before you even start trading is seen as vital.
Like what? Stretching?
Well, maybe, but more like being physically ready, well-rested, properly fed and hydrated, getting regular physical activity like walking, or even just some deep breathing exercises. Basic stuff, but important.
So don't trade when you're tired or hangry. Seems obvious, but...
It sounds basic, but it's huge. And mental readiness is equally key. Trading from a dedicated space, making sure personal life distractions are handled or set aside, being focused. The sources really stress that knowing when not to trade is perhaps the most critical part of the plan.
Saying no to yourself.
Yes. If you're tired, if you're feeling overly emotional, or if you've already hit your predefined daily or weekly loss limit, you simply step away. End of story.
It seems like consistency and discipline are just hammered home again and again, even on days when you just don't feel motivated, right?
Absolutely. The sources really emphasize that discipline overrides desire. Success in trading comes from adhering to your plan consistently, day in, day out, even on days where you might lack motivation or energy, that lack of will they mention.
The protocol matters more than the mood.
Exactly. The protocol you've set in your plan is more important than how you feel or the immediate results of a single trade. It's about being obligated to follow your rules, almost like an employee following company procedures, regardless of their personal mood that day.
This all brings me back to that anecdote you mentioned from the sources, the one about the sick cats. How does that fit in?
Yes, that story. It was about trying to intervene with these cats due to an emotional desire to save them, despite knowing there were underlying genetic issues, making their recovery highly unlikely. That emotional intervention, born from wanting a different outcome, actually led to prolonged suffering for the animals and wasted effort.
Okay, I see the connection.
Similarly, in trading, trying to interfere with market movements based on your emotional reactions, fear, greed, hope, rather than sticking to a rational, predefined plan, is often counterproductive. It ends up being much more painful both to your capital and your mental state. Recognizing when to step back and accept the outcome dictated by your plan, like accepting a small loss when your stop loss is hit, is vital. Just as accepting the reality of the cat's condition was necessary to avoid causing more suffering by fighting a losing battle.
That's a really powerful parallel. Accepting the outcome dictated by your rational plan, even if it's a loss, is less painful in the long run than letting emotion drive you to fight against the reality of the market or your strategy's limits.
Exactly. It's about acknowledging what is and following your protocol, rather than trying to force an outcome based on how you wish things were or how you're feeling in the moment.
Got it.
And the sources also note that finding a supportive community of other traders can be really helpful.
Yeah? How so?
Just in navigating the emotional roller coaster, staying consistent, sharing struggles, especially helpful during those challenging periods or on difficult days. It combats the isolation.
Makes sense. Okay, finally, there's this fascinating distinction the sources make between knowing something and being able to do it.
Yes, this is where the psychological challenge becomes maybe the most tangible. You might know exactly what you should do.
Yeah.
Intellectually, you understand your trading plan perfectly, you know the risks, you've read the book.
You've got the knowledge.
Right. But that knowledge doesn't automatically guarantee you'll be able to execute it when emotions like fear or greed are surging through you in real time.
Like knowing smoking is bad.
Exactly. You might know smoking is bad for you, but the ability to actually quit is a whole separate challenge, isn't it?
Yeah.
In trading, the hurdle is developing the practiced ability to rigidly stick to your plan and execute your known best practices, especially when market volatility is high and triggering intense emotions. This ability is what they call the execution guarantee.
So it's not just about having a brilliant strategy or knowing all the rules, it's about the mental and emotional fortitude, the practiced ability, the discipline to actually follow through on that knowledge when it's hardest.
Precisely. And that ability isn't just learned, it's built. Through disciplined practice, consistent adherence to the plan, and actively confronting your own reactions over time, not just through intellectual understanding of market mechanics.
Wow, okay. We've covered a lot there, contrasting two very, very different paths to building wealth.
Yeah, we looked at the path of consistent long-term investment framed as, a simpler habit-based approach that's pretty accessible to anyone, really focused on steady accumulation over many years.
The slow and steady path. And then the path of active trading, clearly defined as a highly specialized, incredibly demanding profession where the primary challenge isn't even the market itself, but mastering your own psychology.
The intense internal battle path.
Right, and the core message running through the sources, relevant to both but absolutely foundational for trading, seems to be that long-term success isn't about finding shortcuts or relying purely on analytical skill.
No, it's built on consistent habits, disciplined processes, and that continuous effort of managing your internal world, especially when the pressure mounts.
So as you, listening, think about this deep dive, maybe consider which of these paths, or perhaps even just parts of them, resonates most with your goals and your personality right now. And perhaps think about the one small, consistent habit, or maybe a single clear rule you could realistically implement this week, just to take one step in that direction.
And the focus maybe shouldn't be on the outcome you hope for immediately.
Yeah, focus less on the outcome maybe, and more on just building the process itself, starting that habit, defining that rule.
So after all that, what stands out most to you?